Welcome to the Monocle Banking Podcast, curated by Monocle Solutions. There's an old line in banking that capital is global, but regulation is stubbornly local. And this month we were reminded of that truth in rather public fashion. The proposed 2.8 billion rand sale of Bidvest Bank to Nigeria's Access Bank, which was trumpeted as another step in Pan-African banking consolidation, fell over when certain conditions weren't met by the long stop date, and it was announced back in December of 2024. There weren't fireworks, just a regulatory clock that seemed to run out. And in South Africa, when it comes to control of a bank, that clock ticks inside probably one of the most sophisticated and demanding regulatory architectures on the continent. We've got the Twin Peaks model under the Banks Act and the Financial Sector Regulation Act, the FSRA. So today we're asking a question that's bigger than simply why did this deal collapse, which is interesting in and of itself. But we're also asking, why do cross-border acquisitions of South African banks succeed? Why do they stall? What does it actually take to get one over the line in 2026, given that there has been all of this change in regulation as well? And joining me is someone who's, lived at the intersection of all of these forces for over 2 decades. She's advised lenders, borrowers, regulators, and development finance institutions on all kinds of complex cross-border transactions. Deborah Carmichael is an executive in the banking and finance practice at ENS, one of the top law firms in South Africa, and widely recognized by Chambers, Legal 500, and IFLR. She's really advised on some of the most market-shifting projects in South African banking. So, Deborah, great to have you on the show. Welcome to the Monocle Banking Podcast. I've got to ask you, how did you come to find yourself in the finance side of the corporate legal space?
That is a fantastic question, Michael. I never for a minute thought that I would be a banking and finance lawyer. So I grew up in Swaziland thinking, what do I do from here, really? And I wasn't clever enough to be a doctor. And so I decided that I was going to study law. Studied law at UCT, loved Cape Town. And so I decided to find a job here once I was ready to find my articles. I found my articles at a law firm called Denes Rates. Denes Rates subsequently became Norton Rose Fulbright, but at the time that I joined Denes Rates, we were one of those sort of very big law firms for that time that had specific disciplines in corporate commercial, banking and finance. We had a really strong litigation team. And, when you're a young lawyer, you kind of have no idea what it really all means and how you want to progress your career. Anyway, so I started my life out as a corporate M&A lawyer, and I was just like, this is going to take me a really long time, and all the people who sit around me are so old. And I was like, let me do something a little bit more exciting. So that was probably way back in 2003. And banking as a discipline in law was just starting to take hold, not say it was just starting to take hold, but it was just starting to take hold as a separate discipline.
Yes.
And the guys there were slightly younger, they were a little bit cooler, and I was just doing things that I'd never, even imagined. So things like derivatives and securities lending, and it was just this entire other world. And I thought, this is actually kind of nice. And so I stayed, and I've been doing it now for 22 years.
And, that was, just as it happens, just a couple of years before the global financial crisis as well. So you really cut your teeth in the midst of one of the most interesting and fascinating times for global banking. South Africa's banks insulated to some extent because of exchange control regulation, but you must have found that period a crash course in really coming to grips with the ins and outs of South Africa's banking regulation as well. And just before the A2 banking crisis.
100%. It was a fascinating time to be a lawyer at that time. And even though the South African banking market, as you say, is slightly insulated because of exchange control, we were sort of loosening up exchange controls at that time and trying to enter the international markets. And so things, for example, like the development of the derivatives market and those sorts of things in South Africa were very tied to some of the international banking transactions. So Lehman Brothers, Credit Suisse, all of those kinds of things. It was really fascinating. Actually, exchange control has been one of the things that I've followed throughout my 20-year career as it's kind of evolved and changed and relaxed and tightened in some ways. And sort of allowed us to enter the markets again. And I think it's not only exchange control that, open inverted commas, saved us, closed inverted commas. We've always had a very, very good banking regulator. That was the South African Reserve Bank back in the day, and it's now a little bit more evolved, as you say. But our legislation has always been pretty rooted and very, very good, and we've got a really robust legal system. And so our banking sector, as small as it is, has always had very good legislation to guide it. And obviously, we follow our G20 obligations, and so we've followed by and large all of the Basel Committee guidelines and all of those sorts of wonderful things. So our banks are solid institutions.
And I suppose, one could even argue because of that, whether or not it is fit for purpose, that we follow to the T some of the Basel III regulations around holding higher quality capital and maintaining stronger liquidity ratios. And because we were doing that all so well before Basel came along, and we also need to be mindful of our developing nation status. And the reason that banks exist is to provide brisk capital to spur economic growth. So, we can go down a rabbit hole on that one. I want to come back to the Bidvest Access collapse. And let's start at the obvious point. I think publicly we're told that certain conditions weren't fulfilled by the long stop date. From your perspective, and maybe without speculating on confidential detail, what are the typical regulatory friction points in a cross-border bank control transaction that can cause exactly this kind of outcome? Because it had been dragging on for over a year.
It's a particularly interesting one, right? Because, and maybe you'll get there a little bit later, but if one looks at the types of transactions that have been successful in South Africa in the banking space, it really is where the home host country has legislation that is similar to, or probably more robust than ours. Now, if you look at the Access Bank Bidvest situation, Access Bank's platform in South Africa is not a fully fledged bank like a Investec or a Standard or Nedbank. It operates as a branch office in South Africa. And by and large, its prudential capital is then slightly less. Its regulatory oversight is not as stringent as that of a fully fledged bank. Now, its home host country, being Nigeria, will be its primary regulator. We all know that Nigeria is currently going through a massive capitalization regime with all of its banks because the naira devalued and they were worried about prudential capital in Nigerian banks. Now, prudential capital and regulatory capital is not the only consideration in a South African scenario. So get your prudence right. But given where we have now evolved into this Twin Peaks model, you've also got to disclose significant owners, so people who can materially influence the outcome of decisions at bank level. And the other fundamental thing is the PA, which is now that's the Prudential Authority, which is now the main arbiter of an acquisition, will seek concurrence from the Financial Sector Conduct Authority. So conduct outcomes and how you treat customers are also fundamental to bank acquisition, fundamental to bank establishment, fundamental to transfers of assets into banks, and all of those sorts of other things. So in as much as prudence is important, so is conduct, treating customers fairly.
And what does the PA need to see from a foreign acquirer? If we get granular, that it might not need necessarily from a domestic one, because you make a very clear point in an article that you wrote on this, that foreign bidders not already embedded in South Africa do face a steeper evidentiary climb.
Yep, 100%. Now, we're going back to what we've kind of said. So our Banks Act follows, in terms of its regulations, the Basel requirements. So that's number one. And to your point, there's a big philosophical debate about whether or not African banks should follow Basel requirements as a starting point. I'm not sure what Nigeria's banking laws stipulate in relation to that. So already the requirements in terms of filling out your bank's returns and your audit requirements are extremely high. So if, for example, there is a mismatch between the kinds of prudential requirements that Nigeria has versus South Africa, that's certainly going to be a steeper climb. As I say, we all know that once the naira devalued, the Central Bank of Nigeria required all of the Nigerian banks to go out and recapitalize. I'm not suggesting that that was the reason the deal failed, but that's certainly one of the things that sort of jumps up quite clearly to me. In addition to filling out all of those forms, you're going to have all sorts of risk management policies. You have to have disaster recovery policies. The central bank is super concerned about remote banking, and so your IT systems and how your IT systems run. Outsourcing is a fundamental concern for the PA. How do bank systems run when they are not run within the bank? Who are we outsourcing to? How is information traveling? Is information traveling across borders? All of those sorts of things. I mean, it's a fundamentally huge undertaking to convince the PA that you can run a bank in the way that we kind of almost just accept and take as given in South Africa, because our banks are generally very good. Not all banks are the same across the world, as we probably know. And so those are the hoops that you have to jump through. So I think you'd almost have to put together a case for yourself that says we're capable of running a bank in South Africa. It doesn't matter that we're capable of running a bank in Nigeria, for example. We need to be capable of running a bank in South Africa according to PA standards under the Banks Act, the Financial Sector Conduct Authority's outcomes, and we also comply with the Financial Sector Regulation Act.
Yeah. And when we look at the FSRA, the Financial Sector Regulation Act, before Twin Peaks, we had the Barclays ABSA transaction, which was, yes, we know complex, but arguably more linear. Now we've seen the structural shift. And post FSRA, you've described the path as broader and deeper and more tightly sequenced. So what's fundamentally changed from the previous regime? Where is the real escalation now in complexity for banks looking to do deals? The reason I ask as well, because I see a lot of potential acquisition activity between South African banks also going into Kenya, but one might see something coming the other way.
Yep, 100%. So watch out for my next article with Mahesh from our Kenyan office in terms of cross-border opportunities in relation to banking acquisitions. So let's just go back to the question. And your question was, we had this very linear system where we didn't have what we now know as the PA. We had what is called banking supervision. And the banking supervision department sat in the South African Reserve Bank. And the South African Reserve Bank was this sort of present omnipotent father that did everything in relation to monetary policy, sort of financial stability mandate, running of the banks, bank supervision, etc. And that was the only hurdle through which you had to jump. You had to convince bank supervision, that you had deep enough pockets and enough capital to be able to run a bank. And that was where the test sort of began, and that was where it ended. I mean, obviously those tests are pretty complex and very, you need auditors and all the very smart people to crunch numbers and do all of these things, because obviously banks are interesting creatures in the sense that they actually borrow money from us, the general public. But that was the beginning and end of the test. Right. That was where it ended. If bank supervision within the South African Reserve Bank was happy that you were a man of good standing and that you could calculate all of the BA returns in the way that they needed them to look, that was it. Remember, we've kind of also moved from a traditional banking model where people go into the bank with their piece of paper and their check and they deposit it, and there's a standing desk that you could go and wait at. Now we are in a very cool, upwardly mobile world where banks don't necessarily have presence on the ground. They operate through apps or kiosks and things.
It's all ones and zeros.
100%, exactly. And so bank supervision has evolved into less of a prudentially managed role to a more wholesome, client-facing, customer-facing, cyber risk management. All of those kinds of things, are brought to bear. I mean, those things were also there in our previous regime. Obviously, like a bank's IT system must work and it must have appropriate firewalls and the stuff. But, hacking and all of these wonderful things have just gotten so much more sophisticated. And especially, for example, if you're simply running your bank through an app, you've got to have really tight controls. So I guess to make a long story longer, it went from money really as the focus to how are you running this as a wholesome entity, and how are you interfacing with your customers? Are your customers going to be safe if they come and put their hard-earned cash, in a bank account with you? Far more regulation in terms of customer outcomes, but also just integrated technology outcomes as well.
Fascinating. And without going into too much detail on that, I just want to shift to the significant owner regime as well, because I think it's a concept that is often misunderstood. Under the FSRA, control isn't just about crossing a threshold, 50% or 74%, whatever it is. It's about what is called material influence. So, I mean, how wide is that net of material influence in practice? Because that seems to be rather vague. I mean, could a shareholder think they're buying an economic stake only to discover they've triggered some kind of regulatory control scrutiny?
Yeah, 100%. And I think so there's gates within the Banks Act insofar as ownership is concerned, and then there are thresholds within the Financial Sector Regulation Act. The Banks Act are simply sort of reporting thresholds, probably oversimplified it, but anyway, they're sort of reporting thresholds at various levels. But the FSRA's analysis, as you say, is do you, even if you haven't necessarily met specific thresholds, are you a significant owner in that you can materially influence the outcome of decisions at bank level or financial institutions level? And that's the crux of what they try to get to in that piece of legislation. So not only must you comply with a specific percentage threshold in terms of ownership under the Banks Act, what we try to look for here is who is the directing mind behind this institution. We must know that person. That person must be fit and proper. That person must not be a delinquent or a person on a sanctions list or all of those kinds of things. So, yeah, it's broad and it's wide for specific reason.
Yeah. And we know as well that, when you cross certain thresholds, there are thresholds, the 49%, 74, Section 54 reorganizations, the minister becomes involved. How political is that layer in practice? Is it just purely a technical public interest test, or does systemic symbolism matter here?
Yeah, I mean, good question. As a lawyer, I'm going to say to you, it's a public interest test. But yes, I mean, I think the minute the government gets involved, there are all sorts of other overlays in the analysis, right?
As we know, politically exposed can come to mean a whole host of interesting things. And, that's a whole Pandora's box that one might open. You've also got Section 54, which is a reorganization, and you need a consent there. And that's where some of the so-called sleeper risk in these transactions can awaken. If the deal contemplates things like asset transfers or amalgamations or maybe an internal restructuring, how early should that path be built into the critical timeline? Is this where the long stop dates often become quite fragile?
100%. I mean, these kinds of transactions are not your ordinary M&A transactions. Two corporates, who decide that they want to get into bed together and off they go into their merry way. There might be a few tricky things that they need to navigate, but those are always sort of commercial things that they need to navigate and things within, either sellers or buyers' control. This is a transaction that would be rooted in engagement with the PA from the get-go. And the PA likes to be socialized early on to what is happening, who's interested, who the people are. If you were to, for example, establishing a bank requires you to submit a form that ends up being hundreds of pages long. So yes, I mean, firstly, whenever you have a institution that is regulated by statute, the very first thing you need to do is run to the regulatory lawyers and say, how long do you think this is going to take? And the PA is under other than under the sort of Public Administration Act, it's not under an obligation to respond within particular periods of time. And they do a very thorough job of going through each section, for example, and you talk about Section 54. What does it mean to transfer assets into the bank? Is it going to impact prudence? Is it going to impact systems? Is it going to impact the risk profile? Are customers going to be treated fairly? How do we deal with the assets of the bank? Those things need to be socialized very early on with the PA, and it needs to be kept abreast of the process.
What is a realistic regulatory calendar for a bank control transaction in South Africa today? Because your typical M&A long stop might be 6 to 9 months. That seems to be very optimistic when you're talking about all of this. I mean, it just seems to be sequencing and regulatory, I wouldn't say nightmare. It's certainly a lot of work for you lawyers, but it's a lot of work and a lot of time.
It's a lot of work, it's a lot of time, and you have to have a lot of patience. Yes, a typical M&A transaction is probably going to take you about 6 to 9 months. This one can take you anything from 12 to, I would say 24, depending on how complicated or how complex, the incoming relationship is. For example, appointing the right kind of board members is a fundamental part of an acquisition. The PA's got really strict fit and proper requirements, and it takes very seriously who it allows to be directors on the board of a bank. So it's all of those things, probably about anything between a year and a half to 2 years.
Yeah. And as you said earlier, if you want to be successful, you should be designing the deal around supervision and these kinds of things and socializing the details with the PA from day one. I suppose the legal structure against that backdrop can actually seem like a less important question compared to the supervisory comfort. But when you're choosing between the direct acquisition as a foreign bank controller or interposing a South African public company as a controlling company, what determines that kind of decision if you're looking at structuring a deal to get over the line? Because I know Bidvest has reopened and relaunched the process. So I guess the obvious question is, what are the lessons we can learn from this? What type of buyer is most likely to succeed?
So very interesting a question, right? I mean, we've had a number of interesting deals this year where we've seen new bank entrants come into the market. People like Revolut, they're a funky, cool bank.
Yeah.
We've seen Pepcor's announcement that it's going to open a bank. I think Shoprite or Checkers, I can't remember.
It's open season for banking. I mean, you get a bank.
100%. You get a bank. We all get a bank. I don't know. So actually, following the article that I wrote, there were people out saying, hey, I have an investor from the UAE who's been wanting banking assets. So to be perfectly honest, Michael, it is anyone's guess. But again, I said our South African banks are run pretty well. And so the asset in and of itself is a fantastic asset. And I mean, if you look at Bidvest has a full banking license, a full authorized dealer capability. So you'd be getting a real cherry. I think if you had big growth prospects and how to develop a product that isn't currently covered by the South African market, it's a good acquisition, I think.
Fantastic. Deborah, thank you so much. It's been an absolute masterclass in how bank deals really work, going into some of that regulatory plumbing underneath. Really fascinating. I'll be looking out for your article on the opportunities into the East African banking sector. I'm sure it's going to be coming out shortly. Thanks so much for your time.
No problem, Michael. Thank you for having me on your show.
Well, if this conversation tells us anything beyond the fact that this is complicated, is that in South Africa, you don't buy a bank. You earn the right to control one. While capital may be mobile, credibility and governance and supervisory trust and time, so important an ingredient, those are really the true currencies of cross-border banking. You've been listening to the Monocle Banking Podcast, curated by Monocle Solutions. And remember, if you enjoyed the conversation, you'll find more episodes unpacking the forces reshaping banking, capital markets and the real economy wherever you get your podcasts. Until next time, I'm Michael Avery.